channel. I'm Doris and I'm here to share with you about my stock account update. Today my stock account has earned $1,834. Today US stocks closed with a general loss. Google's 2 consecutive decline days dragged the Nasdaq lower. So let's first take a look at my account. Right now the net asset of my account is $71,129.89. Today, the PL is a gain of 3.12%, including the post-market price to or $2,155. Still, the total loss in my account is $30,051.57. Today, SKQ rose made a gain of $1,430, and DRV made a gain of $725. As for the market today, market showed a general loss. Dow Jones Industrial Average showed a loss of 0.73%. Nasdaq Composite showed a loss of 1.02%, and S&P 500 showed a loss of 0.88%. Today, Google showed an exceptional loss with a loss of more than 4%. Therefore, Internet Content and Information ETF decreased for 4.05%. Software and Infrastructure decreased for 1.06%. Medical Devices decreased for 2.2%. On the other hand, due to Tesla rising, Auto Manufacturers ETF rose for 1.54%. Google's parent company, Alphabet, fell for a second straight day, dragging the Nasdaq down. Investors continue to focus on corporate earnings and the Fed's monetary policy outlook. U.S. stocks opened higher on Thursday as all 3 major indexes turned lower in the afternoon as concerns about the Fed's policy outlook outweighed positive corporate earnings. Mr. Ed Moyle, senior market analyst at Oanda, said, Wall Street cannot remain optimistic. Some traders are betting that the Fed will have to adopt more tightening than Wall Street forecasts. Investors have been watching comments from the Fed officials for clues about future policy initiatives. The Fed raised rates by 25 basis points earlier this month. On Tuesday, Fed Chairman Jerome Powell said U.S. inflation is slowing, but interest rates could continue to rise. On Thursday, Richmond Fed President Barkin said the most important thing is that the Fed continues to raise interest rates to ensure that inflation is brought back to its 2% target. Given the demand slowing but still strong, the healthy labor market, and the growing impact of the conflict between Russia and Ukraine, inflation should not be surprising. Although the peak of inflation may have passed, that is why we would still raise rates to stick to the end. New York Fed Chairman No. 3 William Williams said on Wednesday that the Fed needs to maintain a tight enough monetary policy for a few years to reduce inflation, and that a terminal interest rate of 5% to 5.25% is a reasonable view. Fed Governor Tim Cook said Wednesday that interest rates continue to be needed to curb inflation. She said the Fed has taken strong action to curb inflation, although it is right to tighten inflation at a smaller pace but as policy moves forward. Before that, several Fed officials said future interest rates were possible and that the peak could be higher than expected. JP Morgan CEO Jamie Dimon warned that it was too early to announce a victory over inflation and that the Fed could raise interest rates above 5% if it proves sticky. In addition, Mr. Dimon said the country would face a catastrophic default unless its debt ceiling is raised. New Edge Wealth Cameron Dawson, Chief Investment Officer, said the next level for the S&P 500 rally will be around 4,300, which will bring it back to its August high. But once we hit 43,000, we'll trade at 19.5 times, which is really very expensive, unless you have an aggressive easing Fed. Cameron Dawson added, the technicals of the stock market has definitely improved. They look better than any of this at the time in 2022. So we have to respect that. But from a fundamental perspective, we do see the upside facing challenges. Credit Suisse analyst Andrew Garthwaite said the market still underestimated the possibility of continued wage increases at this stage, and the U.S. stock market is overdoing the rally. From the January non-farm data, the U.S. labor market grew strongly, and the unemployment rate was further down to 3.4%, and the employment rate was significantly more than expected. Meanwhile, the number of jobs openings hit its highest in 5 months in December, indicating strong demand for labor. Initial claims for unemployment benefits also fell to their lowest level in 9 months. Mr. Lisa Charlotte, Chief Investment Officer at Morgan Stanley Wealth Management, warned a rebound in deteriorating corporate earnings and economic expectations, creating a huge disconnect that threatens the market stability. Charlotte attributing the latest rally to potential short-term technical factors. In other words, a technology-driven rally has taken the market away from fundamentals. In his latest report, Goldman Sachs analyst John Jesus said that if the Biden administration's non-compete agreement proposal is approved, it would add fuel to the already hot job market, adding $250 billion to $300 billion a year, up 1.2% per employees. Corporate earnings remain the focus. Disney announced that losing paying users was lower than expected, and both earnings and revenue exceeded expectations. Pepsi's fiscal fourth quarter earnings beat Wall Street expectations. PayPal, Redford, and Expedia will all report results after the close on Thursday. Investors have been watching earnings closely for how company perform with high inflation and their expectations for the future. But despite earnings, Wall Street still expects the quarter. So far, 63% of all of S&P 500 companies have reported fiscal fourth quarter results. Of those companies, 69.5% beat analyst expectations. By now, 79% on average of the S&P 500 companies in the past 3 years have beat expectations, according to the Earnings Scout. On the economic data from Thursday, the labor market reported that U.S. claims for unemployment benefits rose for the first time in 6 weeks, but remained at a historically low level, highlighting the resilience of labor market despite rising economic uncertainty. Initial state unemployment benefits claims rose 13,000 to 196,000 in the week ended February 4th. The number of renewed claims for unemployment benefits rose to 1.69 million, including those who are already receiving unemployment benefits for a week more. The U.S. labor market remains strong in the context of the Fed's most aggressive tightening in a generation. While increasing layoffs have spread beyond tech companies, many businesses, especially small businesses, are still struggling to hire people, while others are retaining the employees they are desperately fighting for. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.